Hello and welcome to the Killik and Co market update. Chinese equities are in focus this week after a very poor performance last year and a continued poor performance as we've moved into 2022. Here's a 10-year chart showing the MSCI China index, and you can see that it's lost over half its value since that peak in early 2021. So what's happening here? Well, there are a number of different headwinds facing the Chinese economy at the moment. Firstly, last year, Chinese regulators introduced sweeping new policies that have been hugely detrimental to some of the biggest companies in China. The policies have supposedly been intended to equalize wealth across the country, but in reality, they have caused Evergrande, one of the country's largest property developers, to default on its debts, and they've made Chinese technology giants such as Alibaba and Tencent much less profitable. If regulators introduce drastic new regulations on very short notice, it makes it very difficult for investors to take a long-term view on investing in a country, and that's likely to deter them from investing. And then on top of that, the US is threatening to delist Chinese companies from American stock exchanges unless they comply with American audit requirements. And that could potentially cut off Chinese companies from American capital. And that's not likely to be good news for Chinese economic growth. And then on top of that, we've got China's rise in coronavirus cases. While most of the world appears to be moving on from the coronavirus, China is still grappling with a huge rise in cases, and it's just imposed another full lockdown on millions of its citizens. And again, that is not likely to be good news for economic growth. And then finally, China has so far refused to condemn Russia's invasion of Ukraine. We're still waiting to see exactly how China will choose to deal with the situation, but any further breakdown of China's relationship with the West is unlikely to be good news for China's economic growth. And secondly, this week we had some changes to the UK's inflation basket. It is always interesting to look at this list of products that is thought to represent the expenditure of the average person. Into the basket we had meat-free sausages, potentially because veganism is becoming much more popular. We've got antibacterial wipes, clearly a side effect of COVID, and we've got pet collars. We know that thousands more people bought pets during lockdown, so it makes sense that pet collars would be added to our inflation basket. And then out of the basket we've got men's suits, potentially because people are now working from home, but also potentially because offices are now becoming more casual. We've also got coal. We know that coal-powered fires are becoming much less popular in the home. And then finally, we've got reference books because people are now much more likely to access information online. So it's great to keep an eye on this basket of products, which is changing all the time, because it gives a really good picture of what people are spending their money on. And finally this week, on the subject of interest rates, the Bank of England and the Federal Reserve have announced this week that they will both be raising interest rates by 0.25%. And the Federal Reserve in particular has said it plans to raise rates several more times this year in order to get rising levels of inflation under control. Let's take a look at the Federal Reserve's latest dot plot. How this works is the voting members of the Open Markets Committee are asked to estimate where they think rates will be by the end of this year, the end of next year, the end of 2024, and over the longer term. And then all of their responses are put onto this chart in the form of dots, and we can have a look at where the clusters of dots are to get an idea of where future interest rates will be. So if we have a look at the dots for the end of this year, they're quite spread out, so it shows there's not a very close consensus, but it does appear that interest rates in the US are likely to be around the 2% mark by the end of this year. So that's potentially a bit higher than previously expected, but it's still quite low in comparison to historical levels. And actually the market reacted quite well to the Federal Reserve's latest commentary, but this is changing all the time, and it's something that we're keeping a very close eye on. Moving on to have a look at next week, it's looking pretty quiet on the corporate calendar, but we are expecting results out from Nike. That's it from us. Enjoy the weekend, and we'll see you next week.